Hi, everybody. Hope you're doing well. It's Nick here, Managing Director at Verta Property Group. So, I'm starting a new series which talks through various parts of property investment in the UK. As some of you will know, I'm Managing Director of Verta. So, over the past 12 years or so, I've worked in various property roles. And as an agency, we've been operating for about 7.5 years and helped investors from all over the world invest in all different types of property. As a result of that, part of our role and our consultation process is to advise investors on the pros, the cons, what they need to think about, what's the upside, what's the downside, and what should really form the basis of your decision. Now, specialist supported housing, also known as social housing, is a massive talking point in the UK. It's probably popped up over the past 2 years, and I would say, between us and our competitors, on average, it's probably the highest in demand product in the marketplace. However, there is a lot of questions around it, and you really need to understand effectively what you're getting into if you are considering investing in this asset class or this segment of the property market. So, especially supported housing, let's go through it, the pros and cons. So, effectively, what happens is you would be buying a complete and tenanted property which has been rented to a local housing authority or local housing provider, and there's a contractual agreement in place. So the benefit for you is you're buying a ready asset with a legal agreement for a fixed return from a local housing authority. Now, obviously, there's been a party involved that's procured that property originally, bought it up or slash refurbed it, and made it compliant with the local authority, agreed the terms with the local authority, and then has since then sold that product as a packaged investment effectively. So that's ultimately what you're getting. Now, in terms of the upside for the investor, firstly, the rental yield is exceptionally high, and that's probably the main thing that gets most people's attention, because you're looking at literally double than what you would get on the traditional buy-to-let market. So they typically range from 9 to 13% net return per annum as a net yield. And obviously, buy to let investors in your likes of Liverpool and Manchester these days are about 5 to 6%. So the first major advantage is the higher rental yield. Secondly, you get income from day one. So again, it's marketed as it's sold as a ready to go asset. So unlike off plan, where you might have to wait 12, 18 months for the delivery of the project, you can generate immediate income from the day you complete on the property, or it will start to accrue from that day. So yeah, that can be really advantageous for investors that want immediate cash flow. The returns are fixed and guaranteed in quotation marks. So you do have a legal agreement with the housing authority, so they will pay you a certain amount each month for that period of time. Now, that period of time is very, very long term, which we'll discuss in a minute, but it is a contractual agreement. So you're not looking at as many void periods or ups and downs or variable returns as you might in traditional buy-to-let investment. Net really means net, so there's no service charges, management fees, or maintenance in general. There are certain clauses within these contracts which state that there can be occasions where the landlord would have to bear some costs, but most of the time it is a straight net return, and you're not going to have any deductions from that. Now, in terms of the timeframes, again, this is another very, very big selling point for people, because they want to get as much security fundamentally as possible. So they are typically fixed for 25 years. Okay. Now, this is slightly different to HMOs, where you're letting to government companies or companies like Mears or Serco, where they typically run from 3 to 7 years. With social housing, with a couple of the providers that are available, you're looking at a 25-year fixed contract. So they'll say, look, we'll give you 10% for 25 years, for example. And then just lastly, in terms of the upside of this type of investment, the returns are typically linked to the CPI index and will increase in line with inflation. Typically, most contracts state that's at a minimum of 1% per annum. So in other words, if you were to look at investment and you would say, look, it's a 10% return, we're locking you in for 25 years. Obviously, in years 15, years 20, that's not as advantageous, because rents increase, the cost of living increases, etc., etc. So 10% today doesn't mean what it means in 15 years' time. As a result of that, they build in an uplift into the contract where you can obviously benefit from that increased return. So that's the advantages there. As you can see, there's a lot of headline, really standout features that do get investors' attention, and they do cause people to say, look, as a result of that, I'm happy to invest 150, 200 grand in this because I want that those benefits effectively. Now, here's the bits you need to consider. Okay, so firstly, you're paying for a packaged product. So ultimately, what's happened is someone's gone out there, they've looked at a development, they've purchased a load of undervalued units, normal residential properties, they've converted them into the specification, i.e., health and safety standards, certain sizes, accessible access, fire safety, etc., and brought it up to a compliant standard. They've then gone to the local authority or the housing provider and said, look, we've got these ready to go. Do you want to take these on board? They've said, yes, we'll have 20 units there. Bang. So they've got an agreement in place. They've refurbed the property. And as a result of that, you are right at the back end of that process. You're going to pay that premium to get that finished and ready asset. So you are ultimately paying a large cost to have that benefit, and for ultimately mitigating that risk that you might or you would have if you were to just purchase a property and try and do it yourself. So there's no two ways about it. You are paying an extra expense to get that ready product. The resale market is limited. This is quite a big one. You do need to think about the long-term exit strategy of any property investment you go into. So when you come to sell these types of property, you're only going to be selling to a cash investor. You're not going to be selling to mortgage buyers, and you're not going to be selling to end users. So it is a bit more niche when you come to exit. As a result of that, it might take a bit longer. And also some contracts, they do have a limitation in place where you can't sell in a certain period of time for things like that. So keep that in mind as well. Cash only. So you can't leverage, as you all know, with a normal buy-to-let investment. Typically, you can put in a 25% deposit and you can leverage the rest of the investment value, meaning you can buy more properties ultimately. With these types of properties, typically there are cash-only investment. There are some cases where investors have said, look, I've spoke to a mortgage broker, I can refinance this further down the line and take some capital out. Look, I'm not saying that is possible. I'm not saying that's not possible. That depends on the deal, the investor, etc. Irrespective, it is a high-risk strategy because you're tying up all that capital in the early days. So keep that in mind. You are effectively having less of a diversification play than you might do if you purchase 2, 3, 4 regular buy-to-let properties. It rests on one counterparty. This is quite a big one for me. So all of these properties, they're typically teed up to have the agreement with one local party. Now, that might be restrictive. If there isn't a huge demand for social housing in that area, let's say that operator goes bust, then who is going to take over that lease? Who is going to rent it to? Who are you going to rent the property to? If you can find a replacement housing provider, and some of these companies, they do have contingency plans in place where there's third parties that will come in and arrange a housing provider or an alternative housing provider, but it's risky, it could be time consuming, could ultimately be expensive through missed income, and there's no guarantee that that will take place. So there is that element of risk. If that housing provider, buggers off to Dubai, and there's you have to rent it on the open market, then obviously the rental income that you're going to generate is going to be significantly lower than that fixed return from the housing provider. So your rental yield then becomes a lot less, which one affects your cash flow, and in the long term it can affect the resale of your property as well, because ultimately these properties are linked to the commercial value that they produce. They're priced to yield effectively. So if you've got a property, two of the exact same properties, one generates a 15% return a year, one generates a 5% return a year, obviously the one that generates a 15% return is going to be worth more, and that's reflected in this model. So keep that in mind as well. And lastly, legislation can change. Different different political parties can get into power, different pricing models or budgets can vary in different locations. In other words, one council, one local authority might have so much budget they can put towards, vulnerable housing, affordable housing, etc. But if the government policy changes come in and they affect that, then that can affect the demand and the supply in that area. So legislation is something you have to think about, and government policy is something you have to think about as well. And again, that might depend on the who you're renting to, the demographic of the tenant that you're renting to. So just keep that in mind. You are somewhat exposed to that, but to be honest, you are in the regular open tenant market as well. So I hope that helps, guys. Just wanted to give you a quick snapshot of the pros and the cons of specialist supported housing. If you are considering this type of investment, we do have plenty of options available, and we'll give you a transparent understanding of whether this can be suitable for you or not, perhaps you're better off going into regular residential property. Perhaps you're better off looking at student accommodation, regular HMOs, property investment bonds. We can give you a diverse overview. So click the details below or click the links below if you want to get in touch and discuss different options. Otherwise, any questions, feel free to reach out as well. And that's Nick at Verta Property Group. Thank you.